Welcome to Market Nerd, where seasoned analysts break down listed companies on the Philippine Stock Exchange. Don't forget to like, subscribe, and hit the bell to get the latest developments and investment ideas in the financial markets. Let's dive in.
Hey everyone, welcome back for another deep dive. Today we're digging into Metrobank, their 2024 annual report, to be precise. A lot of you have been asking about this one, wanting to really get a grasp on how they're doing financially, beyond just the headlines.
Yeah.
What are the big shifts, the trends, and frankly, what does management see coming down the pipeline?
Right.
So we're going to roll up our sleeves and really get into those financials, compare them over the last few years.
Absolutely.
We'll look at the balance sheet, income statement, cash flow statement, the whole 9 yards.
Yep.
Plus, we'll unpack the risks and opportunities they've highlighted. Basically, by the end of this, you'll be able to impress your friends with your in-depth Metrobank knowledge.
That's the goal.
All right, so let's kick things off with the balance sheet, the snapshot of their financial health at a particular moment in time. And, the first thing that smacks you in the face is this consistent growth in their total assets.
Yeah.
2024, boom, a massive jump of $415.45 billion. That's a 13.38% increase from the previous year. And this wasn't just a one-off, right? We saw big increases in 2023 and 2022 as well. So what's the story here?
Well, you're right that consistent growth is a strong signal, right? It shows they're expanding, getting bigger in terms of their overall financial footprint. But, and this is where it gets interesting, when you look closer at the composition of those assets, the mix is shifting. Like cash and those super liquid assets, those actually went down in 2024 by about $5.705 billion, a drop of 14.47%. And we saw smaller dips in the previous 2 years as well.
So it's like they're strategically moving their money around.
Exactly.
I also noticed a pretty significant decrease in what they have due from the Bangko Sentral ng Pilipinas, the BSP or central bank, down quite a bit in both 2024 and 2023. What's going on there?
Yeah, good catch. That's a really important detail. I mean, we're talking a 27.76% decrease in 24 and 17.74% in 23. And the report actually sheds some light on this. Seems like they're pulling back on their term deposits with the BSP. So they're actively seeking out different, maybe more profitable places to park their money.
Okay.
Makes you wonder, where are they putting it?
Right. Well, it looks like one of those places might be trading and investment securities. I mean, that category has been on a tear. Big growth in all 3 years.
Yeah.
And then in 2024, bam, a $485.75 billion increase. That's a 31.12% jump. What's the deal there?
Oh, that is a massive increase. And it really speaks to a more, I guess you could say, dynamic investment strategy. A big chunk of that is in fair value through profit or loss, FETPL. That was a 202.32% surge in 2024. And FETPL, that means those investments are directly impacting the bank's bottom line, for better or worse. So higher potential gains, but also greater risk if things go south. They're clearly comfortable taking on more market risk to chase those returns. And we also saw a big increase in their fair value through other comprehensive income, FVOCI, and amortized cost investments, especially in things like treasury notes and government bonds. So it's not just lending anymore. They're actively managing their investments in various ways.
So speaking of lending, how's their bread and butter doing those core loans? Net loans and receivables seem to be steadily climbing as well.
Yeah, absolutely. And that's a good sign, right? Means they're keeping busy with their core business, up 8.64% in 2024. Similar increases in the previous 2 years as well. They're seeing more corporate loans, more consumer loans, credit cards are up too. So there's definitely a demand for credit out there, and they're filling it.
Okay, let's flip the balance sheet over now and look at the other side, liabilities. What's popping up there?
Well, just like their assets grew, so did their liabilities. Up significantly in 2024, 2023, 2022. Big picture. More money coming in. And the lion's share of that is deposit liabilities. Those went up by a solid 8.02% in 2024.
Okay.
Driven by higher time deposits, more money flowing into those cash accounts, current and savings. But there was an offset because some of their longer-term deposits matured. And we saw a similar pattern in 2023.
Now, there was one line item that really caught my eye. Bills payable and securities sold under repurchase agreements, SRA.
Right.
Huge jump there, like 91.63% in 2024, and a big increase in 2023, too. What does that tell us?
You're really picking up on the key details here. That big jump in SRA, that indicates they're leaning more heavily on short-term borrowing. specifically through repurchase agreements, where they're essentially selling securities with a promise to buy them back later.
Hmm.
It's a way to manage their short-term funding needs, keep that cash flowing smoothly.
Okay, so last thing on the balance sheet, let's talk equity. The bank's net worth, it seems like that's been trending upward too.
It has been. Total equity attributable to the bank's shareholders was up 8.09% in 2024. And that growth, that's mainly driven by their profits. You subtract the dividends they paid out, and then there's some adjustments for the value of their FVOCI investments in their retirement plan. But overall, that steady increase in equity that strengthens their financial base makes them more resilient.
All right, so we've got a good grasp on the balance sheet. Now, let's shift gears to the income statement.
Okay.
This tells us how profitable they've been.
Right.
What are the big trends there?
Well, if you look at the big picture, the income statement shows they're becoming more profitable. Net interest income, that's their bread and butter, the money they make from the difference between what they charge for loans and what they pay on deposits. And that's been consistently growing.
Okay.
Up in 24, 23, and 22. Same with fee income, the money they get from things like transaction fees, credit card charges, that's been steadily climbing as well.
Now, what about other sources of income? Any surprises there?
Oh, yeah. One thing that really jumps out is trading and securities gain, loss net. That's been on a bit of a roller coaster. In 2024, they had a huge gain, $8.90 billion. But the year before, in 23, they actually had a small loss. And that came after a very strong gain in 2022. So it just shows you how much their earnings can swing based on market movements, especially with their larger holdings of trading securities.
So a bit of volatility there. All right. On the flip side, how have their expenses been behaving?
Total operating expenses have been going up in recent years, up by almost 11% in 2024. Slightly larger increase in 2023.
Okay.
In 24, the increase was mostly from higher manpower costs, taxes, licenses, and then a bunch of miscellaneous expenses. And managing those expenses, that's always crucial for a bank's profitability, keeping them in check.
One thing I noticed, their provision for credit and impairment losses, that actually went down. What's the significance of that?
That's a good sign. It basically means they're having to set aside less money to cover potential loan losses. So maybe fewer borrowers are struggling to repay their loans, and when that happens, their profitability gets a boost. And it's been decreasing for the past 3 years, so that's a good trend.
So let's get down to brass tacks. How did all these revenue and expense trends impact their bottom line, their net income?
Well, the bottom line looks pretty good. Net income attributable to the bank's shareholders, that was up by almost 14% in 2024.
Okay.
And that comes after a really strong 29% jump in 2023.
Wow.
And solid growth in 2022 as well.
Yeah.
So they're consistently becoming more profitable, and that's also reflected in their earnings per share, which have been steadily increasing over the past 3 years.
Okay, so we've covered the balance sheet, the income statement. Let's quickly touch on the cash flow statement.
All right.
The summary in the report wasn't super detailed here, but were there any key movements that we should be aware of?
Yeah, they didn't dive deep into the specifics of the cash flows, but we can kind of connect the dots based on what we saw in the balance sheet and income statement.
Oh.
Like when deposit liabilities increase, that means more cash is coming in from operating activities.
Right.
And then, those big changes in their trading and investment securities, those would be reflected in investing activities.
Makes sense.
Buying securities uses cash, selling them brings cash in.
Yeah.
And then on the financing side, you'd see things like issuing new bonds or paying off old ones. They did mention paying out a pretty substantial cash dividend to shareholders in 2024. That's a cash outflow. And then any big investments they made in property and equipment, those would also show up as cash outflows for investing. So to really understand the nitty-gritty of their cash flow, you'd need to dive into that full statement.
All right, so we've done our hands dirty with the financials. Now, let's switch gears a bit and talk about what management sees as the big risks facing Metro Bank. What are they worried about?
Well, they highlighted a bunch of key risk areas. One is market risk, the potential for losses from things like changes in interest rates, currency exchange rates, and just general market volatility. And given their larger holdings in foreign currencies, debt securities, and derivatives, that's definitely a big one they're keeping an eye on. They use all sorts of fancy tools to assess this, like value at risk, VAR, for their trading activities.
And what about that classic banking risk, borrowers defaulting on their loans?
Oh, absolutely. Credit risk is always top of mind. And they're being proactive. They're using what's called a forward-looking expected credit loss model, or ECL.
Okay.
It basically tries to anticipate potential defaults based on historical data, current economic conditions, and what they think might happen in the future. And then they also have their own internal credit rating systems to evaluate how risky each borrower is.
Now, liquidity risk, the risk of not having enough cash on hand to meet their obligations.
Yeah,
That's got to be a big one for banks.
it is. And they're on top of it. He said they're constantly monitoring their liquidity position, making sure they have enough cash to cover their obligations as they come due. They maintain what's called a market contingency outflow, or MCO, within certain limits.
Okay. So beyond these core financial risks, what else are they concerned about?
Well, operational risk is another biggie.
Mhm.
This includes things like internal process failures, human error, system glitches. But it also covers external events that could disrupt their business. And of course, a big part of that these days is cybersecurity.
Oh, for sure.
They have a pretty robust IT governance framework in place. Security protocols, they do regular staff training on cybersecurity awareness, and they have procedures for reporting and managing any security incidents that do occur.
It's interesting that they also specifically mentioned environmental and social risks. That seems to be a growing concern these days.
Yeah, it's definitely become a bigger focus for financial institutions. Yeah. And they're acknowledging the systemic risks that come with environmental degradation and climate change. They've actually implemented an environmental and social risk management framework, ESRM, to assess and mitigate these risks. They're particularly concerned about physical risks, like damage from extreme weather events and transition risks associated with the move to a low-carbon economy.
Yeah.
Plus, they're thinking about social risks, like labor unrest and cyber threats. And then finally, they're worried about reputational risk, especially when it comes to compliance with anti-money laundering regulations. They really emphasize strong customer due diligence procedures to make sure they're not involved in anything shady.
Okay, so they're aware of the potential pitfalls, but on the flip side, what are they excited about? What opportunities do they see for Metro Bank in the future?
Well, digital transformation is a huge theme for them. We're really pushing that. They highlighted the success of their Metro Bank Wealth Manager platform and the upgraded PS Bank mobile app. They're really seeing those as game changers for customer experience and making their operations smoother.
And sustainable finance, it seems like that's a big focus for them too.
Absolutely. They're really proud of their sustainable finance framework. They've already channeled a bunch of money into green projects, and they see that market growing even bigger, aligning with the increasing interest in renewable energy, green infrastructure, and all those good things.
They also talked about financial inclusion.
Yes, they're actively working on programs to help out MSMEs, those micro, small, and medium enterprises, and to promote financial inclusion for everyone, including women entrepreneurs and social enterprises. They also mentioned specific green financing initiatives and their ongoing efforts to promote financial literacy. Strategic partnerships, like the one they have for that solar energy project, are also a big part of their growth strategy.
Okay.
And expanding their presence in rural areas and the remittances market, those are key too.
All right, final question. Did management give any specific guidance on what they expect for future revenue and earnings? Any hard numbers?
Well, they didn't lay out any specific forecasts in the report. No hard numbers. But you can get a sense of their thinking from their overall strategy.
Okay.
They're clearly bullish on digital transformation, sustainable finance, expanding into new markets. That all suggests they're expecting continued growth. They're also emphasizing risk management and operational efficiency, so they're aiming for sustainable profitability. And they called out their sustainability efforts as a fundamental driver of our long-term strategy. So they're definitely betting on those initiatives to pay off in the long run.
Okay.
Now, they did mention an upcoming analysts briefing.
Oh, right.
Maybe they shared more detailed projections there, but we don't have that info in this report.
All right, so to wrap things up, it seems Metro Bank is in a pretty good spot.
Yeah.
Their assets, loans, deposits, they've all been growing. Their profitability is up. And they're keeping a watchful eye on those risks while also pursuing exciting opportunities in areas like digital and sustainable finance. So while they didn't give us any concrete numbers for the future, their actions speak louder than words, right?
Yeah.
And this leads to an interesting question for you all to think about. Given everything we've discussed, what do you think will be the biggest drivers of Metro Bank's performance in the year ahead? Will their digital push pay off? How will their focus on sustainability impact their competitive edge? Maybe keep an eye on their next financial report, see how those trends play out, and of course, keep an eye on the broader industry landscape. Lots to watch here.
Liked what you heard? Drop a comment, like, and share this episode. Hit subscribe and tap the notification bell. We've got more insightful market ideas coming your way. Catch you on the next one.